That means a recession is well underway.
Yes, housing is likely in a recession.
That is one definition of a recession.
U.S. where the economy is heading.
In 2022, the United States did not experience a severe crisis, but there is still a ticking time bomb in the country's economy that many people are unaware of. The Federal Reserve is primarily responsible for the inflation that the country is currently experiencing, and the American consumer has not reduced their consumption despite the high inflation and increased credit costs, making the measures taken by the Federal Reserve less effective than anticipated. Increasing interest rates is hoped to encourage people to save more money and consume less to stabilize prices, but if people continue to consume at the same levels, the actions of the Federal Reserve will be less effective, potentially triggering the next economic crisis in the United States. People have avoided reducing their consumption in two ways: by depleting their savings, which have reached minimums in the last 17 years, and through debt. The problem with this is that it is not free for consumers to behave in this manner. The United States economy, which is based 68% on consumption, managed to avoid a deep crisis this year thanks to the support of its citizens, but without resolving the underlying issue, the ticking time bomb will go off when people are unable to access more credit or end up depleting their savings, leading to widespread bankruptcy for the American consumer. Although the United States technically entered a recession when its economy declined in the first 2 quarters of the year, it was such a weak contraction and with such a low unemployment rate that the institution responsible for declaring recessions, the National Bureau of Economic Research, declined to do so. The threat of a crisis has caused stock markets to rise, and the market value of some of the world's largest companies, such as Tesla, Meta, and Amazon, has dropped by more than half. The analysis has dim forecasts for the coming year, with surveys of economists and analysts putting the probability of a financial crisis anywhere from 60 to 90%. When consumers are finally unable to maintain this vicious circle, demand will fall, starting a domino effect that will eventually lead to an economic crisis. Less demand from consumers will imply that businesses will have to cut back on investment, and many companies, such as technology companies this year, will be forced to readjust their investments and begin laying off employees. An increase in unemployment will further deteriorate demand, and the crisis that was anticipated to occur this year will finally take place. The severity of the impact will be determined by a number of factors, but inflation will play a central role in all of these scenarios. In the first scenario, the Federal Reserve has some wiggle room to cut interest rates and help the economy recover if it so chooses after the drop in demand to stabilize prices. However, many economists and investors, including Michael Burry, Peter Schiff, and Muriel Rubini, consider this unlikely and believe the Federal Reserve will eventually cave to pressure from the people, companies, and markets to lower interest rates and print money again, with disastrous consequences. In the second scenario, the decline in demand is insufficient to reduce inflation, and there is a period of stagflation, which 22% of respondents in a survey of 856 financial professionals conducted by Deutsche Bank rated as the most dangerous scenario, with a 62% likelihood of happening. Stagflation occurs when there is both an economic decline and inflation, and it is a parity between the two. In the third scenario, which is similar to the previous one but with higher inflation, that may be due to a drop in production on a global scale, which in turn reduces supply and maintains high prices. If this were to occur, the Federal Reserve would be forced to become even more stringent and raise interest rates even higher, further worsening the economic crisis by reducing demand and raising the cost of financing for businesses and governments. Despite having eliminated all given the various factors and scenarios outlined, it is difficult to determine the most likely scenario for the U.S. economy in 2023. It is clear that there are several significant risks and challenges that could potentially lead to a crisis. One of the biggest risks facing the economy is inflation, which has been rising steadily and shows no signs of abating. The Federal Reserve has taken steps to combat inflation by raising interest rates and reducing its asset purchases, but these measures may not be enough if consumers continue to spend at current levels. If demand remains high, businesses may continue to raise prices, leading to further inflationary pressures. Another risk is the high level of debt in the U.S. economy, both at the government and consumer level. As interest rates rise, it may become more difficult for consumers and businesses to service their debts, potentially leading to defaults and bankruptcies. The ongoing conflict in Ukraine and other geopolitical risks also pose a threat to the U.S. economy, as they could lead to disruptions in global supply chains and higher energy prices. Overall, it is important for policymakers and individuals to remain vigilant and take steps to mitigate these risks. This may include reducing debt levels, increasing savings, and diversifying investments to protect against potential market downturns. Additionally, policymakers may need to consider more aggressive measures to combat inflation and support economic growth, such as targeted fiscal stimulus or further monetary policy interventions. I would like to know your opinion in comments. See you next time. If you found this video helpful, please subscribe and share it so that we can reach a wider audience and educate more people.